On the morning of October 28, 2025 at 7:43, a veteran bullion bank trader named Marcus Chen sat in his London office and watched something that should have been impossible. The lease rate on his terminal, the cost to borrow silver for 30 days, had been 25 basis points when he arrived. By the time he poured his second coffee, it had spiked to 200% annualized. His phone rang. New York. They needed metal, physical metal, now. Marcus had worked the precious metals desk for 17 years. He had seen flash crashes and margin calls and algorithmic meltdowns, but he had never seen this. In the next 72 hours, COMEX vaults in New York would hemorrhage 29 million ounces of silver in the most acute inventory stress in modern history. Not a glitch, not a margin call. A desperate scramble for actual bars when London's floating supply hit critical lows. The math was brutal. Roughly 2 billion ounces of silver traded daily across London, Shanghai, and Chicago. Global mine production? 850 million ounces per year. That meant the paper market was leveraged 2,000% over physical reality. For every real ounce sitting in a registered COMEX vault, there were 33 claims on it, 33 promises, 33 bets that delivery would never be demanded. But October 25th changed everything. An Indian buyer placed an order for 1,000 tons of physical silver. The London market froze instantly. All traders withdrew. Lease rates exploded. Swiss refiner Metalor announced it would not return before January 2026. Marcus stared at his screen as the registered inventory numbers updated. 73 million ounces in early 2025. Now bleeding fast. His colleague in Shanghai sent a message at 8:02. Physical premium over spot, $8 per ounce. That wasn't market noise. That was a scream. Silver in the East was worth $8 more than paper promises in the West. By noon, Marcus received confirmation. 29 million ounces had moved from COMEX to London in 30 days. The largest single-month drain in recent memory. The phone kept ringing. Buyers in Geneva. Buyers in Hong Kong. Buyers in Mumbai. Everyone wanted physical delivery. Everyone wanted metal they could touch. Marcus thought about the analyst reports he had read the morning. They said COMEX inventories were adequate. They said the supply chain was stable. But Marcus was staring at a screen that told a different story. The COMEX had just lost 29 million ounces in 1 month because London ran out. But the real question, the question that made Marcus's hands cold as he watched the registered inventory numbers tick down, was not how they lost it. The question was, what happens when everyone realizes there is not enough metal left to cover the promises? The October drain was not an accident. It was not a technical glitch or a temporary liquidity hiccup that would resolve itself by the next quarterly report. 29 million ounces disappeared from COMEX vaults in 30 days because the physical metal had to go somewhere, and that somewhere was London, where the floating supply had hit levels so critically low that lease rates spiked from 0.25% to 200% in minutes. This was not speculation. This was documented fact. The bullion banks needed actual silver bars to settle obligations they had made in a market that trades roughly 2 billion ounces daily, while the world's miners produce only 850 million ounces per year. Think about that ratio for a moment. Every single day, traders buy and sell more than twice the entire annual global production of silver. The leverage is not hidden. It is structural. Wall Street told you the inventories were healthy. In early 2025, COMEX registered stocks had climbed to 73 million ounces, and the financial media called it adequate supply. But here's what they did not mention. COMEX registered inventories had collapsed 70% from their 2020 peak of 346 million ounces to just 82 million ounces by late 2023. That 73 million ounce surge they celebrated, already depleted by 29 million in 1 month. The vaults were not refilling. They were being drained to cover a fractional reserve system that had made promises it could not keep. And the Shanghai premium told you exactly what was happening. When physical silver in the East trades at an $8 premium over COMEX futures in the West, that is not a temporary arbitrage opportunity. That is a market screaming that paper claims and physical metal have decoupled. The arbitrage gap is the real price of scarcity. It is the cost of admission to a market where delivery actually matters. Our trader in London knew the deficit numbers cold. Global silver mine production in 2024, 819.7 million ounces. Total demand, 1.16 billion ounces. Annual deficit, 282 million ounces. Fifth consecutive year of shortfall. Cumulative deficit since 2019, 1.3 billion ounces. The world had consumed 1.3 billion more ounces than it mined, and someone had to supply that difference. For years, the answer was vault inventory. But the vaults were running dry, and the paper system had just proved it had a physical problem it could not solve with another futures contract. The reason the system cannot fix itself is not complicated. It is physics. Silver has the highest electrical conductivity of any metal, period. It has the highest thermal conductivity of any metal, period. You cannot replace it in the applications that matter most to the industrial economy we are building right now. Over 50% of annual silver consumption flows to industrial applications, with 2025 demand projected to exceed 700 million ounces, driven by technological megatrends that are not optional. Solar panels, electric vehicles, AI semiconductors. Each electric vehicle requires roughly 1 ounce of silver. Samsung's new battery technology demands approximately 1 kilogram of silver per vehicle for 1,000 mile range. The chemistry does not care about the price. The chemistry requires the metal. Global solar installations hit record levels exceeding 200 gigawatts annually, and each megawatt needs 2,000 to 3,000 ounces. You cannot build the green energy transition without silver. Photovoltaics consumed 197.6 million ounces in 2024 alone. Electric vehicles are forecast to consume over 90 million ounces yearly. These are not speculative bubbles. These are infrastructure buildouts mandated by governments and funded by trillions in capital that has already been allocated. The demand is locked in. Now look at the supply side of this equation. The LBMA has only 140 million ounces of floating supply, but daily trading volume reaches 600 million ounces, with over 2 billion ounces of paper claims on top of these 140 million ounces. That is the fractional reserve pyramid. 1 ounce of physical silver corresponds to more than a dozen different certificates of ownership. The modern precious metals market is a leverage scheme built on the assumption that most claims will never demand delivery. As of mid-2025, total silver futures contracts represent about 1.2 billion ounces of paper silver, more than the total mined silver in the world this year. The leverage ratio is roughly 33 to 1. For every real ounce in a COMEX vault, there are 33 claims on it. The registered inventory available for delivery is only 47 million ounces currently, a small fraction of the 291 million ounce total in the COMEX system. Only registered silver can be delivered against futures contracts. The rest, classified as eligible, must be persuaded to sell. And when physical delivery requests spike, the persuasion stops working. October 8th, 2025. An order for 1,000 tons of silver placed by India triggered an immediate freeze in the London silver market. Silver lease rates instantly skyrocketed from 0.25% to 200%. All traders withdrew. Swiss refiner Metalor announced it would not return before January 2026. The operational precision of the system collapsed in minutes because the system was never designed to handle actual delivery at scale. The deficit is not closing. In 2024, global silver mine production rose by 0.9% to 819.7 million ounces. The 2025 forecast projects 835 million ounces, an 11-year high. That sounds bullish until you understand the structural trap. 75 to 80% of silver production comes as byproduct from copper, zinc, and lead mining, meaning higher silver prices cannot stimulate production increases if base metal economics do not justify operations. Primary silver mines comprise only 25 to 28% of global output. You cannot mine more silver just because you want to. The geology does not work that way. Here is the calculation that matters. 2024 total silver demand, 1.16 billion ounces. 2024 mine production plus recycling, approximately 1.01 billion ounces. 2024 deficit, 149 million ounces. Cumulative deficit since 2019, 1.3 billion ounces. Global mine production is stagnating around 813 to 835 million ounces, while total demand exceeds 1.2 billion ounces. Recycling contributes approximately 150 million ounces. Combined primary and secondary supply falls dramatically short, and the demand is accelerating. Industrial fabrication is poised to top 700 million ounces in 2025 for the first time in history. Photovoltaics consumed 197.6 million ounces in 2024. Electric vehicles are forecast to exceed 90 million ounces yearly. These are not cyclical trends that reverse when the economy slows. These are structural shifts in how energy is generated and stored and transported across the global economy. The inventory bleed confirms the crisis. COMEX deliverable. Registered silver inventory increased from 30 million ounces in summer 2023 to over 73 million ounces in early 2025. But then COMEX shed nearly 70 million ounces in just a few months. London silver inventory reached near all-time lows of 827 million ounces in December 2024, of which 551 million ounces is reportedly spoken for by unsecured silver ETF holdings. Shanghai inventories hit decade lows. Borrowing costs spiked to 200% annualized during periods of acute tightness. Industrial stockpiles now cover only 30 to 45 days of consumption versus historical 90 to 120 days. Compare this to oil. Annual global oil consumption runs around 100 million barrels per day. Strategic reserves cover roughly 180 days. Silver? The LBMA's free float is only enough to cover about 6 weeks of global demand. When you're running a just-in-time supply chain for an irreplaceable industrial metal with a structural deficit of nearly 300 million ounces annually, 6 weeks is not a buffer. It is a countdown. The obvious solutions will not work, and here's why. First, the idea that miners can just produce more silver. Declining ore grades demand more processing for less yield. All-in sustaining costs rose 40% since 2020 on energy and labor inflation. New mines take 7 to 10 years to bring online amid regulatory delays. Mexico, the world's largest producer at 25% of global supply, faces a marginal 0.2% decline to 231.8 million ounces in 2025 due to lower output from the San Julian mine as it approaches end of life in 2027. And remember the structural constraint. Silver is primarily a byproduct. When copper prices fall, silver production falls, regardless of silver's price. Primary silver mines produce only 25% of global output. The rest comes from base metal operations focused on copper, lead, and zinc. You cannot command geology to cooperate. Second, the hope that recycling will fill the gap. Recycling rose 6% in 2024, reaching a 12-year high of 193.9 million ounces. But there's a ceiling. A recent study concluded the cost to infiltrate a landfill and recycle 1 ounce of silver was estimated to be north of $300 per ounce. Current spot price ranges from $30 to $65 per ounce depending on market conditions. The economics do not work, and most silver used in industrial applications is consumed, not recycled. Solar panels last 25 plus years. The silver is gone. Electronics end up in landfills. The silver is molecularly dispersed, lost. Third, the assumption that ETF liquidation will flood supply. iShares, Silver Trust contains around 529 million ounces of silver. Sounds like a lot. Except 551 million ounces is reportedly spoken for by unsecured silver ETF holdings in London. And there is the question of whether the 100 million ounces of silver inventory reported by SLV, stored by JP Morgan Chase, is also being reported by JP Morgan as COMEX inventory. The regulators have yet to answer. The delivery crisis is already here. A dramatic 60% of COMEX's registered silver inventory was claimed for physical delivery within just 4 trading days in late 2025. When everyone wants physical, the paper system cracks. The silver market is experiencing backwardation. As we approach January delivery, the silver contract is now at the highest open interest when compared to all prior minor months. Spot prices exceeding futures. That is physical scarcity screaming. And the system's response? The Chicago Mercantile Exchange announced that due to a problem affecting the cooling system of its data center, servers had to be shut down, leading to the closure of the silver futures market during a massive price spike in late 2025. The system cannot handle the squeeze. Silver shattered all-time highs exceeding $61 per ounce in December 2025, representing a 90% year-over-year gain that outpaced gold's 60% rise. This was not cyclical, this was structural, and the winners and losers were already being sorted. The paper traders holding over 300 derivative claims for every 1 ounce of eligible silver at LBMA and COMEX faced a liquidity crunch when physical delivery requests spiked. Cash settlements were already rumored to be close to being forced. Short sellers watched silver lease rates skyrocket to 200% annualized, making the cost of maintaining short positions existential. Industrial buyers who waited found themselves paying Shanghai physical premiums that exploded to over $8 per ounce above COMEX futures. The arbitrage gap became the real price. But the physical holders won. Companies like Vizsla Silver secured $300 million in convertible note financing to advance operations. Eric Sprott became the largest shareholder of America's gold and silver, holding approximately 20%. Smart money positioned before the squeeze. Unhedged miners printed cash as current silver prices nearing $40 provided substantial profit margins over typical production costs of $20 per ounce. Primary silver producers who refused to hedge their production during the manipulation years were finally vindicated. Contrarian allocators who understood the deficit arithmetic before Wall Street admitted it existed were rewarded for their patience. The analyst consensus shifted. UBS now sees silver as increasingly vulnerable to liquidity squeezes, expecting upside bursts and price spikes. Analyst Joni Tevis says silver should outperform gold in 2026, with upside cases pointing toward $55 to $65 per ounce. Keith Neumeyer, CEO of First Majestic Silver, maintains his triple-digit silver prediction, calling for $100 plus silver. His warning is direct. You cannot continually run in a deficit in the physical market and not have it show up in the paper market. David Morgan stated that the day of reckoning is when the physical market takes control of the paper paradigm. That day arrived in October 2025. Silver's unique position as both precious metal and critical industrial commodity creates demand dynamics fundamentally different from gold. The green energy transition is not optional. The AI build-out is not slowing. These are not speculative bubbles. These are infrastructure mandates backed by sovereign capital. The 29 million ounce drain was the tremor. The underlying issue of a world running short of metal remains completely unresolved. Metals Focus says the world is facing the deepest silver supply deficit ever on record, about 295 million ounces for 2025 once ETF flows are counted. The COMEX did not lose 29 million ounces to theft or error. London ran short. Bullion banks pulled actual silver off COMEX shelves and shipped it across the Atlantic. The paper market just admitted the physical market is in control. Not a conspiracy, a deficit problem. 2 billion ounces traded daily. 850 million produced annually, 295 million ounce shortfall this year. When industrial demand for an irreplaceable metal exceeds production by 35% annually, the price correction is not a question of if, only when.